Hello investors and welcome to my YouTube channel where I study the best investors and businesses from around the world. This week we learn how you can invest during the period of inflation according to tips from Warren Buffett. As you know, we are heading into a period where we do expect higher inflation coming out of the lockdown as the economy recovers, as businesses come back to life. We do expect higher inflation, and businesses that perform well during periods of higher inflation might be different from businesses that perform well during a period of low inflation or low interest rates. So we'll be going over the characteristics of businesses that will do well in a period of high inflation according to Warren Buffett. Without further ado, let's get right into the video. Just to give you a little bit of context behind the high inflationary environment that we live in, an article from CNBC says, "Markets do expect high inflation coming along despite rising inflation. Experts say the Fed won't budge on rates." Stocks have been tethered over the past week to rising Treasury yields and the possibility that the Fed will tighten monetary policy to tackle an expected rise in inflation. Chairman Jerome Powell acknowledged that some upward pressure on prices could occur as the economy reopens, noting that he expects the central bank to be patient on policy action, even if the economy sees transitory increases in inflation. What this is saying is that the market expects higher inflation. Therefore, the market also expects the Fed to increase the Fed rate, and what this means is that the interest rates will increase. This will have negative impact on businesses that have high debt balance because when interest rates go up, they have higher interest expenses, leaving less money to get paid out to shareholders. So that has caused a lot of nervousness and the sell down in the stock market. The central bank is going to sit back and relax for a bit, even though there might be inflation in the short term, as long as there isn't any disorder in the market. During the pandemic, people were willing to accept a low rate on bonds. They were just dumping everything, buying bonds. The Fed was also buying up a ton of bonds just to stimulate the economy, but now as the economy has recovered and the economy starts reopening, people are more confident. They're now selling bonds, and that results in an increase in the 10-year Treasury yield. So now let's talk about why inflation is bad for stocks. The main reason is an increase in hurdle cost. The hurdle cost is made up of two costs. Number one, the visible cost of capital, which is made up of the cost of equity plus the cost of debt. Cost of capital equals the cost of equity plus debt. So the cost of equity is basically the cost of having shareholders' money in the business. So when you pay out dividends or if you buy back shares, that is money going out of the business, paying back to the shareholders the cost of debt, and which is the cost related to borrowing money from the bank or other institution and having to pay interest. So those two costs make up the cost of capital, and that is visible in the business. Number two, the inflation rate, which is an invisible cost. So Warren Buffett explains this quite well. He says, a business earning 20% on capital can produce a negative real return for its owners under inflationary conditions, not much more severe than presently prevail. This was said in 1977, where there was a 6.5% inflation compared to today's, which is at 5.5%. So if the company is earning 20% on capital, but say, for example, inflation is 25%, then the investor is actually worse off by investing in business because they've only invested money and returned 20%, whereas the cost of everything else in the world has gone up by 25%. This suggests that they've lost purchasing power, and that is a real cost to the shareholder. Ideally, you want a business that can go beyond that hurdle cost to make a real rate of return for the shareholder, and that is why we've actually seen so much of the high-flying growth stocks and the spec stocks sell off, and the reason is because previously we were in a period of very low inflation, possibly even deflation, and a period where the cost of money was so cheap that you can literally borrow money at close to 0% interest rate. And what that meant is that the cost of capital was very low. So the hurdle cost was really low. And what that meant is that even businesses that were unprofitable, that had no revenue whatsoever, were up exorbitantly. We've seen the share prices of some of these spec stocks and some of these pre-revenue stocks go up quite significantly, and now we've seen these companies' share prices have recently decimated in the market sell-off. A higher hurdle cost doesn't mean that investors do need to be a bit more selective with their stocks, and Warren Buffett does actually give us 2 tips on picking these good types of stocks. He suggests that a business will need to earn a sufficient return on capital, and if inflation rate increases, then the company will still be making a return above the hurdle cost. So what do you invest in an inflationary environment? In the 1981 Berkshire Hathaway's letter to shareholders, Warren Buffett tells us to invest in companies that have these 2 characteristics. A, an ability to increase prices rather easily without fear of significant loss of either market share or unit volume. These are companies that have a monopoly or strong moat around the business, a company that has significant competitive advantage over its competitors. In other words, companies that have a product or seller service in which their customers have very inelastic demand. So if the company raises their prices, customers will probably just have to accept higher prices, pay those higher prices, and get on with their lives. So I can think of businesses like Coca-Cola, for example. If they did increase their prices of a can of Coke from $1 to $50, chances are that people will still buy Coca-Cola because they like the product. Customers usually tend to have strong brand affiliation with a product, so we want to look at those types of companies that sell those types of products or services. B, a company that has the ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. These sound a lot like companies with tech stocks, where there's no additional cost of providing one more unit of product or service just because they don't really have any raw materials related to that type of product. For example, if we're using Coca-Cola again, with Coke, if you want to sell more Coca-Cola, you will need to get a bigger factory, you need to pay someone to make the product, and you need to have a lot of logistics just to get that product to the consumer. There's a lot more capital invested into that product compared to a company like a software provider like Microsoft, where there isn't any marginal cost related to providing one more unit to a customer. So these 2 characteristics actually fit really well to the profile of a technology company. And you could argue that it is easier to find these companies these days compared to when Warren Buffett was writing this in 1981. Just because there isn't as much of the tech presence in the market. But right now, there's a lot of tech stocks that actually fit these 2 criteria, including Google, Microsoft, and Facebook. These big tech stocks at the moment have really strong economic moats. These companies have a really high return on invested capital, and they can probably increase their production or increase supply of their services without any additional investment required. According to Mr. Buffett, these are companies that will do well in a period of inflation. Depending on how the situation plays out, even if we don't enter a period of high inflation or moderate inflation, these companies will do well because these companies have a very good business model. They spit out a lot of cash, and remember, these companies have a net cash position. So even if the cost of borrowing goes up, these companies won't be affected, and in fact, if the cost of borrowing goes up, then perhaps their money sitting in the bank will earn them a higher rate of return. So these companies will actually benefit from the higher interest rates compared to other businesses where they have a lot of debt, a lot of leverage on their balance sheets. If you enjoyed this video and you found it helpful in some way, then please remember to leave a like on it. This really helps my channel grow, so please like the video and subscribe to my channel so that I can continue to make videos like this for you to enjoy.